The new leasing standards are one of the biggest accounting changes in history, and one that is going to result in trillions of dollars of leases for things like office space, company cars, computers, industrial machinery and equipment moving onto corporate balance sheets for the first time as assets and liabilities. Now, these new lease accounting standards were well publicized for over 10 years before they were released, but few companies were ready for them when they were announced. Even some of the largest, most sophisticated publicly traded companies, the ones that can close their books and report earnings just a few days after the end of the quarter, are struggling to adapt to the changes. Now, for sure, the accounting is complex, and the guides from the Big Four firms number in length over 1,000 pages, but the root causes go much deeper than the accounting. Historically, companies have never really maintained an inventory of what they lease because there was never really a business reason to. So they need to go on a bit of a scavenger hunt from department to department trying to identify all their leasing contracts. So when they find them, they need to read them closely because they need to abstract over 100 different pieces of information. Things like rent formulas and payment schedules and renewal options. The accounting calculations generate millions and millions of journal entries, so it's far too complex to manage with a spreadsheet. So IT organizations are having to implement specialized lease accounting software packages. But getting those to work is challenging as well because there are literally over 100 billion different combinations of use cases they might encounter. Now, the balance sheet doesn't change very often, so these new standards are going to attract a lot of attention from institutional investors, board members, and especially from external auditors who are going to want to make sure that the accounting is accurate and complete. So it's important that companies get this right or risk an audit deficiency and material weakness, or worst case, even a financial restatement, which could really damage your reputation in the marketplace.